$65 trillion. That's the amount that's projected to be flooded into the private markets by 2032.
Today, I'm joined by a fantastic guest. His name is Seth Bradley.
Seth on here, SEC attorney, doing a bunch of things. Excited to have him on here. A wealth of knowledge.
I want to introduce you all to Mr. Seth Bradley. Mr. Seth, how you doing today, sir?
Seth is with a portfolio of firms that he runs. One of the main firms he focuses on is Raise Law.
We've done 750 funds and syndications. We've done $9 billion in transactions, representing $3 billion in capital raised for my clients, partners, and for myself. I grew up in West Virginia. My dad's a retired coal miner. My mom's a retired grade school teacher. So I wasn't really exposed to entrepreneurship or owning real estate or anything like that. You know, obviously there's a difference between personal and business, but the closer you can make those two things the same, the more you're gonna feel kind of centered in life and the more fulfilled you're gonna be. Entrepreneurs, we're always on the forefront of that, and we just need to be ready and see those opportunities and take advantage of them. I wanted to put my baby girl up there. She's 7 months old, so I'm a new dad and really loving it, and she's fucking adorable. I mean, look at that. Just always remember your why, right? Like, always remember why you're doing it. It's not just to get rich, not to get wealthy. All right, folks, eat, sleep, raise, repeat. This is go time. So let's fucking go. So first of all, you really need to determine if you're dealing with a security or not. If you're dealing with a security, then it's going to be a fund or it's going to be a syndication. If you're not dealing with a security, then it can be a JV. And that's kind of the whole point. Yeah, so if you go into like a joint venture, right, we're in the non-securities realm, then everybody, that means you have no passive investors. That means every single person in that deal, all of your partners, all the people giving you money, every single one of them has to be an active partner in the deal. Not one of them can be a passive investor. So passive meaning they give you money and they're expecting a return on that capital due to the work that you do, not due to the work that they do. Now, work can be misconstrued because you think of work as in swinging the hammer, signing the loan docs, doing the asset management, if we're talking about real estate, running the business, if we're talking about a business, things like that. But it can also mean doing work, can also mean having actual voting rights, meaningful managerial rights, making decisions on behalf of the LLC or the company. So that's also work. So just because you're not swinging a hammer doesn't mean you're not an active partner. Active can also mean managerial voting rights as well. If every single person in your deal or in your LLC or in your partnership is active and none are passive, then we're in joint venture territory. And you don't have to worry about any of the accreditation or anything like that. You can have people that are not accredited. This is just like you and me getting together and saying, hey, let's start a business, right? Because that's what you're doing. Everybody's active. You and me are both business partners. We get together. Maybe I put in some money, you don't put any money, but you're going to do a lot of work, but I'm still going to make decisions. That's fine. Like that's just kind of your general, business structure, right? How you start a business, whether that's real estate or whether that's any other kind of business, an HVAC business, as opposed to if you have passive investors that are just in it to give you money and expecting a return on that money, then now we're talking about securities. That's right. That's right. It doesn't matter what the size of the deal is. Now, I will say that sometimes when courts or the SEC or folks like that are evaluating it, they might look at the complexity of the deal and say, okay, does it really take 55 people to buy a 12-unit apartment building and operate it? So is it really a joint venture? Is everybody actually doing something? I don't know. I don't know. It'd be pretty tough to make that argument. But if everybody has equal voting rights, everybody pitched in the same amount of money, everybody and they have pro rata voting rights based on their money, that's probably a JV. Because think about like investment clubs. That's kind of a hot thing right now. Like investment clubs, you get like 30 people together, everybody puts in money, nobody gets paid to raise the capital. It's really a joint venture is what it is. But everybody votes. Like you vote, like if Fractional is one of your guys' sponsors as well. You get on their platform and you vote. Every person in an LLC votes. They say, yes, I do want to invest in this target deal or we want to invest collectively in this target deal. Everybody votes yes or no and makes decisions together. Document-wise, JV is going to be simpler. You're just going to have an operating agreement or a limited partnership agreement depending on your entity structure, and that's it. So you need to form your entity. You need to have some sort of an operating agreement to govern that entity, and that's all you're going to have. You're not really going to have any kind of, because it's not a security, you're not going to have any federal filings or anything like that. It's much more simple, right? It's just one governing document. Just like, you form an LLC, get together with your business partners and you put something together. That's all it is. As soon as passive investors enter the equation, that's where it gets complex. That's where the SEC comes in. That's where security state commissioners come in, and they want to see the proper filings because they want to regulate it, right? They want to make sure you're not screwing over grandma for her last $50,000. That's why the SEC was created, to protect investors from predatory folks that might be trying to scam people out of money. So that's why it was created. That's why we have all these rules and regulations. And if you go the syndication or the fund route, you're going to have a subscription agreement, you're going to have an operating agreement, and you're going to have a PPM. PPM, little known fact, you don't actually have to have a PPM necessarily if you have all accredited investors. If everybody's accredited, it's not legally required that you have a PPM. Now, should you have one? Absolutely, because it's a shield for you to not get sued or to protect you from lawsuit down the road. But do you legally have to have it? You don't. Sometimes if it's a really small syndication, you might actually just put some risks and disclosures as an exhibit to your operating agreement. You can do it that way too. But you certainly want some sort of risk disclosure and CYA for sure. And then I'm trying to think where I was going with that. Yeah, and then you've got your SEC filings. So you're going to file your Form D or your Form A or your Form C if you do a Reg A or Reg CF or Reg D fund, depending on what you do. But there'll be some sort of an exemption filing with the federal body, which is the SEC, and then you have to do your blue sky notices to each state where your investors are housed or where they live, and then pay the requisite fees, of course. So there's a lot more involved, right? And there's other costs involved too, right? So like legal costs. For an operating agreement, you can go to a real estate attorney or maybe kind of your local, your cousin who does a general practice in law, right? Like you might be able to get away with going to somebody like that compared to if you do a security, you need to find a securities attorneys. Now there are a few securities attorneys out there that moonlight as one, but they're actually real estate attorneys or they don't really have the background in it. But you really need a real securities attorney to practice securities laws. It's a very specialized practice, and typically you've got to work at a big law firm to get that sort of experience. I would just ask what their working history is, like where they worked at, like what law firms. We're kind of in this, I like to call it an influencer community where we've got these masterminds. So there's maybe like 5 or so of us, smaller boutique securities law firms that work with all of you all. But a couple of us have a big law background. The other ones probably do not. They probably worked in like a general practice, and then they saw an opportunity where they're like, oh, we can make some money doing securities. Let's do that. And then they just kind of figured it out as they go, which, is okay. Because if you do it for long enough time, you end up learning it and figuring it out. But see what they practiced before. See if they practiced securities since day one, or see if they, did like trust and estates and, family law or something in the past. And you're like, oh, they were like a general practitioner. And then all of a sudden they said, we want to specialize in securities. Really hard to get that. I guarantee they made a lot of mistakes along the way, because unless you have that big law training, again, it's really tough because not too many, let's say, smaller law firms or boutique law firms have a securities practice.